Hello everyone, and welcome back to Explain the Charts. Today is November 18th, 2025, and we're diving deep into the S&P 500 ETF, ticker symbol SPY, which has been experiencing some serious turbulence. In this video, we'll first cover the crucial news and macroeconomic events driving this volatility. Then, we will perform a multi-timeframe analysis of the charts to identify key levels, trends, and potential trade setups. The overarching theme in the market right now is uncertainty, primarily centered on the Federal Reserve. We've seen major indexes take a hit over the last week, with last Thursday, November 13th, being a particularly brutal day where the S&P 500 sank 1.7%. The core reason for this downturn is that investors are rapidly paring back their bets on a December interest rate cut. Just a month ago, a cut was seen as a near certainty, but now the odds have dropped to roughly a coin toss. This sentiment shift is being fueled by mixed signals from Fed officials. While some like Governor Waller are pushing for a cut, others like Boston Fed President Collins are signaling opposition, creating widespread confusion. Adding to the uncertainty is the fallout from the prolonged government shutdown, which has delayed key economic data like the September jobs report, now expected this Thursday. White House officials have even warned this data could be permanently impaired, leaving the Fed to make decisions with an incomplete picture of the economy. Meanwhile, the AI boom continues to be a major narrative, with some calling it a rational bubble. Nvidia's earnings report, due this Wednesday, is being watched by the entire market as a bellwether for the tech sector and the AI trend's sustainability. We're also seeing broad risk-off sentiment extending to other markets, with cryptocurrencies entering a bear market regime and Bitcoin erasing all of its gains for 2025. This combination of central bank uncertainty, data ambiguity, and high stakes in the tech sector is creating the perfect storm for the volatility we're seeing. Now, let's turn to the daily chart for SPY to see how this narrative is playing out in the price action. Looking at the bigger picture, 2025 has been a very strong year, with a clear uptrend carrying SPY from below 500 in the spring to a peak just shy of 690 in late October. That all-time high area around 689 is now our most significant long-term resistance level. However, the price action in November has marked a stark reversal of this trend. We see a series of strong red candles, confirming the bearish news we just discussed. The sharp drop on November 13th is clearly visible here, showing a decisive rejection from the highs. Following a weak bounce attempt, yesterday's session on November 17th saw another leg down, with price closing near the lows at 665.67. This recent action has established a clear short-term downtrend, with a pattern of lower highs and lower lows. The immediate support level to watch is the low from yesterday and last week, right around the 662 to 663 zone. If that level fails to hold, the next major area of support is the swing low from October, down around 653. Let's zoom in on the price action since the beginning of October to get a better look at this reversal. Here we can clearly see the final push to the all-time highs through October, followed by the sharp turn in early November. Notice the increase in volume on the recent down days, particularly on November 13th and November 17th. This elevated selling volume suggests strong conviction from the bears and adds weight to the downward move. This price action tells a story of buyer fatigue, a term one strategist used, where the bullish momentum simply ran out and sellers took firm control once the narrative on rate cuts began to shift. The market has decisively broken its prior uptrend structure, and any rally attempts have been sold into, creating lower highs. Switching over to the 1-hour chart, we can analyze the short-term trend in more detail. The downtrend is even more defined on this time frame. We can draw a descending trend line connecting the series of lower highs since the peak. This trend line is now acting as dynamic resistance, and the price has been consistently rejected from it on every bounce attempt. For bulls to regain any control, we would need to see a strong, high-volume break above this trend line, as well as the horizontal resistance at yesterday's high around 673.7. Above that, the 680 level stands as a significant psychological and structural hurdle. On the downside, the immediate support remains that critical 662 level. A sustained break below 662 on the hourly chart would be a very bearish signal, likely accelerating the move down towards that major 653 support target. As of now, the price is consolidating near the lows, indicating that sellers are still largely in control of the short-term trend. Finally, for those focused on intraday moves, let's drill down to the 15-minute chart for the last couple of trading sessions. Looking at yesterday's price action, we can see a significant gap down at the open, which immediately set a bearish tone. An early attempt to rally back toward the gap was quickly sold off, and the market proceeded to grind lower for the rest of the day, making new lows into the close. This price action shows a clear lack of buying interest and reflects the negative sentiment dominating the market. For traders looking at today's session, the key levels are very clear. The area around 662 to 663 must hold as support. Any move back up will face initial resistance at the 668 level, and then the more significant zone around 671 to 673 from yesterday's failed rallies. Watch the volume closely around these levels for clues about conviction. So, to recap everything, the market is at a critical juncture. Let's summarize the key price levels to watch. Major long-term resistance is the all-time high around 689. Key short-term resistance zones are 673 to 675, and then the psychological level of 680. On the downside, critical support is at the recent low of 662. If 662 breaks, the next major support target is the October low around 653. Now for our unbiased predictions. The bearish scenario seems more probable in the immediate short term, with about a 65% likelihood. The technical trend is down, and the fundamental picture is clouded by Fed uncertainty. A disappointing Nvidia earnings report or a surprisingly strong jobs report that pushes rate cuts further out could easily send SPY below 662 to test 653. The bullish scenario, which will give a 35% chance, requires a strong defense of the 662 support level. For this to happen, we would likely need a catalyst, such as blockbuster earnings from Nvidia that reignites the AI hype, or a very weak jobs report that puts a December rate cut firmly back in play. A reclaim of the 675 level would be the first sign that bulls are regaining control. The two things everyone should be watching are Nvidia's earnings on Wednesday and the jobs data on Thursday. These events will almost certainly dictate the market's next significant move. That's all for our analysis on SPY today. Thank you for watching Explain the Charts. Please remember, this analysis is for informational and educational purposes only and should not be considered financial advice. Trading and investing involve significant risk, and you should always conduct your own thorough research and consult with a qualified financial advisor before making any decisions. If you found this video helpful, please hit the like button, subscribe to the channel, and let us know your thoughts in the comments below.